Can marketing agencies take advantage of the new QBI deduction? What's up, everybody? My name is Hervochon, CPA. The website is betterwaycpa.com, and let's jump into it. So what does QBI stand for? Well, it stands for Qualified Business Income. Q is for qualified, B is for business, I is for income. Easy enough, right? So this is also commonly referred to as Section 199A or 199 Cap A. You may hear it that way as well. And what this was is part of the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act, commonly are also referred to as TICJA, was passed at the end of 2017. I'm sure that most of you are familiar with that. We've had one full year of operating under the new tax code. That was 2018. We are now into its second year. And this was probably one of the most talked about tax deductions that came out of the new tax law. It's certainly one of the most debated topics from the new tax code. It's very complex. It's very nuanced. And it's, you got to know what you're doing if you want to take advantage of it. So this is a tax cut or a deduction that applies to pass-through entities. Now, what are pass-through entities? Well, those are business types or business entity types that are not taxed at the entity level. Good examples: sole proprietorships, partnerships, and S-corps. None of those entity types are taxed at the entity level. Instead, the earnings are taxed at the individual's level. So, in other words, a sole proprietorship is taxed when you file your individual income tax return. There's no separate tax return for a sole proprietorship. Therefore, the sole proprietorship itself, the business, is not taxed as a standalone. It's taxed when you file your individual income tax return. S-corps are another really good example, and this is a great example for marketing agencies. In fact, all of the marketing agencies that I work with are all S-corps. Now, an S-corp is not taxed at the entity level. However, an S-corp does file its own tax return. When you file that tax return, it's essentially just an information-only return that you give to the IRS, and then you get a K-1 when you file that return. So the K-1 goes to the owner. The K-1, the information from the K-1 then flows into the owner's tax return, and then the owner pays tax based on that income which is shown on the K-1. Pass-through entities. An example of something that is not a pass-through entity is a C-corp. So a C-corp, when you think about the large publicly traded corporations, those are basically all C-corps. The reason being is because they don't have ownership restrictions that the other entity types have. That's beyond the scope of this video. We can get into that some other time. However, C-corps are taxed. When they file a tax return, they pay tax when they file a tax return, and then they dividend out income. So they cut dividend checks to their owners, and the owners then pay tax on those dividends as well. So C-corps are actually taxed twice. And they're not pass-throughs. But for the purpose of this video, 199A, the QBI deduction, only applies to pass-through entities. So in other words, does not apply to C-corps. So what is it? It's a 20% deduction on qualified business income. The way to think about business income, there are exceptions. This is nuanced, like I said, but very, very high level. It's the net income from the business, but you don't include guaranteed payments to partners. If you have a partnership and the partners get guaranteed payments, they're guaranteed an amount out. It doesn't include that. It does not include S-corp or reasonable compensation. If you have an S-corp, you should be familiar with reasonable compensation, and you should have a trusted tax advisor who is advising you on reasonable compensation. And it also does not include investment income. Basically, this deduction applies to the income that's coming out of the business that is applicable to the business's operations. Investment income not applicable to the business's operations or any sort of operating activity. It's more of a passive type income. So here's where it gets a little bit more complex. So if you're an SSTB, your deduction may be limited. What is an SSTB? An SSTB stands for Specialized Service, Trade, or Business. What falls into that category? Health, law, accounting, which is terrible for me, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, any trade or business where the principal asset of that trade or business is the reputation or skill of one or more of its employees, or any trade or business that involves the performance of services that consist of investing in investment management, trading, or dealing in securities. It's a lot there. It almost kind of seems like it covers every business, but I assure you it does not. Are marketing agencies SSTBs? Great question. If we go back to the list, I know what you're thinking. Well, Perhaps my marketing agency would fall under consulting. Perhaps my marketing agency would fall under reputation or skill of one or more of its employees. Those are great points. I've actually addressed that in a blog article, which is a companion to this video. But let's talk about consulting real quick. Consulting, and there's an article that's going to be linked in the show notes to this video. But consulting, what they're really talking about is if you are providing advice to a client and you are not taking any action on that advice. And how does that apply to marketing agencies? Well, if you are saying you should, or if you run media for a client and you're saying, well, you should, put together this ad, or you should do an ad this way, and you're not actually going to run the media for them, or you're not going to put the ad together for them, that's consulting. Now, if you say you should do this, 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 and this, you put together the Facebook ad, and then you run the Facebook ad, that is not consulting. That's part of your marketing agency trade or business. That falls outside the realm of consulting because you're actually taking an action. And this is laid out very well in the blog article that I wrote, I think. So if you need more information on that, go see that. So the second piece here is any trade or business that relies on the reputation or skill. This mostly talks about influencers or people who are endorsing products or services or things like that. You think about professional athletes, LeBron James endorsing Nike. That's reputation or skill. That falls outside the realm of marketing agencies and what you guys do. I know it's kind of a very broad definition, but the IRS has ruled on that, and that's going to be outside of your realm. So, for the purpose of your agency, you are not an SSTB, which means that your deduction is not going to be limited in most cases, unless you are providing consulting, marketing consulting. That's a different story. Then you would need to segregate out that income from marketing consulting and then actual marketing. But that's beyond the scope of this video. Certainly, just be aware of that, though. So how do you maximize your QBI deduction? Here's a couple takeaways for you. If you're just starting out, consider your entity type. If you're thinking, oh, hey, I should go be a C Corp, and you're just a small marketing agency, not a good idea for a variety of reasons, but number 500 on that list is going to be you can't take advantage of the QBI deduction. Like I said, all of my marketing agency clients are S Corps, so think about that. Consult a CPA. Maximize your deduction by carefully considering the wages you pay to yourself and your employees. Like I said, reasonable compensation is not included in the QBI deduction, nor are guaranteed payments to partners. So you want to be thinking about that when you're thinking about how you're going to structure the payments to yourself and what your reasonable compensation is going to be. If you're going to pay yourself more than that, less than that, that's certainly a bad idea too, but for other reasons. Just something to be aware of, something to think about, something to work through. You got to run the numbers. There's a calculator that I put on my website to estimate what your QBI deduction is. It's going to be linked in that blog article that I referenced before. It's also linked in the show notes here for this video. I would recommend that you go and play around with that. That's a good way to plug in some numbers, do some what-if analysis, and to figure out what that deduction might be, because that deduction is substantial. Like I said, it's 20% of essentially the net income of your business. It is an enormous deduction. You want to make sure that you're maximizing that because that makes you more profitable. It gives you increased cash flow, and the benefit to your business is higher than it otherwise would have been. And again, consult a CPA. This is a very, very nuanced calculation. It's a very, very nuanced deduction. The regulations that the IRS put out around this deduction are a couple hundred pages long, so you can imagine the amount of detail that is in there. This video is not meant to be authoritative guidance, but it is meant to tell you what you should be considering, what you should be thinking about, and to get you going down that path of maximizing your QBI deduction. Everybody's situation is unique. Certainly, you need to consult a CPA to take advantage of this deduction and to maximize the potential in your business. And finally, a few thoughts. Number one, the QBI deduction was put in place by TICSA, and it should result in a significant tax savings for you and your business. It is something that you should be aware of, something that you should be taking advantage of. Number two, marketing agencies are in an advantageous position to take advantage of this because they are not SSTBs, like I said. And number three, make sure that you consult a CPA. You definitely want to make sure that you're doing this right. You definitely want to make sure that you're maximizing your deduction. Resources for this video. This video is going to be linked here on YouTube. These slides are going to be out on Google Slides and on SlideShare, so by all means go take a look at those. That blog that I referenced right here, Can Marketing Agency Owners Take Advantage of the QBI Deduction, is a deeper dive into this topic. There's certainly some good information in there, so I'd recommend you go see that. Linked in that blog is the next link here, the QBI Deduction Estimator for Marketing Agencies. Go play around with that, run some numbers, do some what-if analysis. That could be a good resource for you. And that could help to spur the conversation with your accountant or your CPA. And then there's two great articles here. Forbes, this Forbes article, which was written by Tony Nitti. Tony Nitti is one of the foremost tax experts in this country. He is awesome. But the title of the article is IRS Publishes Final Guidance on the 20% Pass-Through Deduction. It's going to be a little bit technical in nature, but it's certainly a great read if you're interested in the QBI deduction. And then finally, the Journal of Accountancy article here on the QBI deduction. That's going to talk about... there's two classifications of SSTBs that I referenced earlier, and it's going to give you a little bit more context. And again, that's referenced in that blog post as well. So I certainly encourage you to go check that out. Let's connect. Chris@BetterWayCPA.com. That is my email address. 843-608-0298 is the phone number. You can find me on Facebook, LinkedIn, Twitter, Quora, Pinterest, and Instagram, so pretty much everywhere. I really appreciate you tuning in. If you like this content, please like it and share it, and please also subscribe to my YouTube channel. That helps me to grow my audience. It also tells me what you like, the content that you like, and helps to inform the kind of content that I should be producing for you going forward. So I really appreciate it. Have a great week, and I will see you next time.